What happens when the country most people treated as predictable suddenly starts using its leverage with precision? What if the neighbor long dismissed as steady, polite, and economically dependent decided to shift one variable inside the system, and that single move began rattling US housing costs while sending a message across the global trading order? That is not speculation anymore. It is happening in real time. Canada is no longer content to operate as a quiet supporting character in North American economics. It is beginning to act like a country that understands exactly where its power sits and what happens when that power is exercised deliberately, and this story reaches far. Beyond timber, what is unfolding now is not merely a dispute over building materials. It is a signal, a warning, and a strategic demonstration that one nation has decided it will no longer be treated as easily manageable. Canada was never built to be passive. It emerged from brutal winters, vast geography, sparse population centers, and the constant demand to survive where survival was never simple. That kind of country does not grow out of comfort. It grows out of endurance. Its national character was shaped by distance, discipline, and the habit of building under pressure. But despite that history, much of the outside world, especially in economic terms, came to see Canada as the more accommodating half of the continental partnership. The relationship with the United States created enormous prosperity, yes, but it also fostered an assumption that Canada would continue supplying what America needed while avoiding open confrontation whenever tensions rose. Over time, that assumption hardened into a pattern. Canada exported crucial raw materials, energy, and commodities into a system largely optimized for American advantage. When disagreements emerged, Ottawa usually responded with restraint, legal process, and carefully measured diplomacy that approached projected maturity, but it also created an image of predictability that others mistook for permanent compliance. The broader lesson many took from decades of this arrangement was simple. Canada might object, but in the end, it would absorb pressure, adapt, and keep the goods moving south. That perception began to fracture when Donald Trump publicly floated the idea that Canada could be treated like the 51 Street state. The remark landed as more than a provocation. It exposed an attitude once suggesting that Canadian sovereignty could be spoken about casually, as if it were negotiable or secondary to American political theater. Many expected Canada to let the moment pass with little more than formal disapproval. But beneath the surface, something deeper was shifting. The country was beginning to reconsider not just how it responded to insults, but how it used the structural advantages it had spent decades underplaying. Then came the adjustment that changed the tone of the conversation. In the opening months of 2026, Canada made a quiet but highly consequential change to the pricing structure surrounding softwood lumber exports. There was no dramatic showdown, no explosive retaliation package, no made-for-television trade war spectacle. Instead, there was something far more effective, a technical pricing move executed within the boundaries of an existing commercial framework. It was calm, legal, and almost understated. But the consequences were immediate. In one of the most sensitive areas of the American economy, the shock was felt almost at once. The reason is basic and brutal arithmetic. The United States depends heavily on Canadian softwood lumber, with roughly a third of its supply tied to imports from north of the border. In some regions, especially those closely integrated with Canadian distribution routes, that dependence is even more pronounced. At the same time, American production capacity has not been in position to close the gap. Mill shutdowns, labor constraints, environmental compliance burdens, transportation issues, and years of underinvestment have all reduced flexibility inside the U.S. system. In other words, the demand remains, but the domestic backup plan does not. That is what makes dependency dangerous, not merely needing a resource, but needing it without a fast replacement. Canada understood that reality. It did not need to blow up the framework. It only had to alter the economics inside it. By raising export prices strategically, it pushed purchasing costs higher for American buyers without resorting to theatrical escalation. That distinction matters. This was not about breaking the machinery of trade. It was about proving who could influence the final outcome most effectively. The move was subtle enough to avoid the optics of aggression, yet powerful enough to expose exactly how vulnerable the other side had become. The first major tremor appeared in housing. Lumber remains one of the essential inputs of residential construction, and when its cost rises, the effects travel quickly through the entire chain. A modest increase on paper can become a serious burden once it is spread across framing packages, contractor bids, project financing, and final sale prices. By early 2026, builders in the United States were facing a punishing set of choices. They could absorb the losses and watch margins disappear. They could delay projects and hope conditions improved, or they could pass the cost on to already strained buyers in a market where affordability had already reached a breaking point. None of those options were good, and for smaller firms in particular, some of them were not even survivable. The pressure did not stop with home builders. Manufacturers that rely on wood inputs from furniture producers to packaging operations to component suppliers immediately began feeling the strain. These are not sectors that can magically re-engineer their supply lines overnight, nor are they always equipped to hedge against rapid cost. Changes the way financial players might. When the price of a foundational input spikes, the damage moves outward, production schedules get rewritten, hiring plans get paused, transport demand softens, overtime gets cut, and whole regional business networks start tightening defensively. This is what makes the strategy so effective. The pain does not arrive first in speeches or government budgets. It arrives in payroll hours, delayed developments, higher invoices, and frustrated families. That is the real brilliance of the move. The United States government does not experience this shock in the abstract. The real burden lands inside the domestic economy. It lands on businesses trying to finish projects, on households trying to buy homes, on contractors trying to keep crews working, and on firms trying to maintain price stability in markets that are already exhausted. Over time, that kind of pressure becomes political whether Washington likes it or not. Canada did not need to shout to create leverage. It relied on something far more durable than rhetoric: structural dependence. And once a country discovers that kind of leverage, it does not need to dramatize it to make it effective. For the United States, the obvious question is whether an alternative exists. In the near term, the answer is deeply uncomfortable. Expanding domestic milling capacity is not something that happens in a quarter or two. It requires capital, permitting, labor, logistics, and time, exactly the things short-run market disruptions do not allow. Import substitution sounds simple in political language, but in operational reality, it is slow and expensive. That leaves America exposed to a hard truth. Trade barriers and nationalist economic messaging do not magically create self-sufficiency if the underlying supply system is still incomplete. In fact, policies meant to defend domestic industry can end up highlighting how little room there is to maneuver when no credible substitute is ready. And that is where Canada's move becomes historically significant. This is not only a pricing decision, it is a psychological transition from being treated as a price taker to behaving like a price setter. It shows a country recognizing that control over key inputs can matter more than volume, noise, or even size. Lumber is especially powerful because it is stubbornly physical. It cannot be downloaded, digitized, or replaced with a software patch. When supply chains are tense and housing demand remains politically explosive, control over something that basic becomes real geopolitical currency. Canada's timing only amplified the effect. Global supply systems were already fragile, inflation anxieties were still present, and construction markets remained sensitive to even small cost fluctuations. In that environment, a pricing move that might once have been dismissed as routine suddenly carried the weight of a strategic declaration. The message was unmistakable. Canada is no longer interested in playing the role of dependable low-cost supplier under terms defined elsewhere. It is prepared to use its position with greater confidence, and it expects that position to be respected. Of course, none of this comes without risk. Washington could respond with political pressure, trade countermeasures, or efforts to accelerate domestic substitution. Markets could turn volatile, media narratives could frame the move as opportunistic or hostile. There is always danger in changing posture after years of restraint, but Canada appears to have reached a different conclusion: that the bigger danger is remaining permanently undervalued in a system that benefits from your resources while discounting your autonomy. From that perspective, assertiveness is no longer the gamble. Passivity is. That is why the rest of the world is paying attention. Other countries are watching this not simply as a North American trade story, but as a model for how modern leverage actually works. Power in the 21st century does not always arrive through spectacle. Sometimes it comes through discipline, timing, and a precise understanding of where the bottlenecks are. Sometimes it comes from recognizing that being reliable does not require being submissive. And sometimes the strongest message a country can send is not a threat at all, but a measured adjustment that forces everyone else to confront how dependent they really are. For a younger generation trying to understand the future of trade and influence, this is the real lesson. Resources are not just commodities on a balance sheet. Under the right conditions, they become strategic instruments. They shape negotiating power, they expose hidden dependencies, and they reveal which countries are still thinking in old assumptions and which ones have learned how to act in a more transactional, more competitive, and more unforgiving world. What Canada has done is bigger than lumber. It is a statement about sovereignty, leverage, and the end of automatic deference. It is proof that a country can remain stable, rational, and highly disciplined while still refusing to be underestimated. And as this next era of global commerce begins to take shape, one truth is becoming impossible to ignore. Power does not always enter the room making noise. Sometimes it changes one number, shifts the burden downstream, and lets the consequences do all the talking.